What I'm about to share with you today is absolutely critical for anyone paying attention to the precious metals market right now. We're witnessing something that hasn't happened in over 40 years, and the implications are staggering. Silver just blasted through a barrier that rejected it twice before in history, once in 1980 and again in 2011. Both times, silver crashed hard after hitting that level, but this time, everything is different, and I'm going to explain exactly why. We're not just talking about a modest rally here. We're talking about silver shooting from $50 straight through $60, $70, $80, and now sitting around $90. The next psychological barrier, $100. And here's the thing. I don't believe silver will pause there for long. Sure, it might get rejected a couple times because it's a nice round number, but the fundamentals driving this move are so powerful that $100 is just another stepping stone on this journey. Now, before I dive into the shocking data that explains why this move is just getting started, and before I reveal the price targets that sound absolutely insane but are grounded in historical ratios and supply-demand fundamentals, I need you to do something. Smash that like button right now. Drop a comment telling me if you're positioned for what's coming, and make sure you're subscribed, because the information I'm sharing today could change how you think about wealth preservation forever. Let me paint the picture of what's actually happening in the silver market right now. For the last 5 years straight, we've had a physical deficit. That means physical demand has outpaced physical production every single year. Now, how has the market handled this deficit? Through futures markets, through paper contracts. But here's where it gets really interesting. The outstanding paper contracts in London and New York are of such magnitude that they cannot be fulfilled by any existing physical stock. There simply isn't enough physical silver to back up all these paper promises. This is a fundamental change from what we saw in the late 1970s. Back then, silver climbed rapidly from a few dollars to $50, but that was primarily speculation by the Hunt brothers. The market could quickly sell enough paper silver to crash the price, and it didn't stay at $50 for long. This time is completely different. Every time the bullion banks attempt to sell silver down, it fails. We've seen it multiple times. Silver gets sold off in the evening trading sessions, and within hours, it's back up again. Just last week, Friday evening saw a sell-off, and silver quickly bounced back to $90. Here's something that should grab your attention. We're already seeing silver trade over $100 in the Far East and in Australia. The Perth Mint is selling silver at over $100 right now. The prices in London and New York will have to follow. This isn't speculation. This is what's happening in physical markets as we speak. So what does this mean if you're holding silver or considering exposure to precious metals? It clearly means that silver is just starting this move. We're going to see multiples of the current price. Will it correct along the way? Of course, silver always corrects. But this is not a normal market anymore, because it's now turned into a physical market, which is what it should have always been, rather than the paper manipulation we've seen for decades. Look at these numbers. Physical demand has gone from 10% of production to now 50% just in the last year. That's a massive increase in demand, and it's coming from multiple sources. Solar panels, electric vehicles, electrical products, electronic devices, and defense contracts. Every missile uses quite a lot of silver. All modern electronic products and weapon systems use significant amounts of silver. The demand is there on the physical side, the demand is there on the investment side, and the production just isn't there to satisfy this demand. The deficits we've experienced over the last 5 years, those deficits are going to increase. This is why there will be constant upward pressure on silver prices. And here's the risk that nobody's talking about enough. It's probable that in the next year or two, we'll see failure in some markets, whether that's in the London market with a bullion bank going under or on the COMEX, we don't know. But the risk is very high. Now, before I reveal the specific price targets based on historical gold to silver ratios that will sound absolutely crazy but make complete mathematical sense, hit that like button, leave a comment with your current thoughts on the metals market, and subscribe, because what I'm about to share might sound unbelievable at first. This is why holding physical metal is absolutely critical. Not ETFs, not futures. Physical silver stored safely outside the banking system, not within the banking system where counterparty risk exists. Physical metal in a safe vault stored outside the banking system entirely. Now, let's talk about gold for a moment, because understanding the gold to silver ratio is crucial for understanding where silver could go. Gold is also climbing, but silver will move twice as fast as gold in the coming years. The gold to silver ratio has already dropped from over 100 to about 50. The long-term historical ratio is probably around 15 initially, but I wouldn't be surprised to see even lower than that as a natural level. The demand is of such magnitude and the supply so limited that silver could easily push that ratio under 15, maybe even to 10. Now, let me walk you through some numbers that might sound outrageous at first, but stay with me. Gold reaching $10,000 is not just possible, it's probable. That's a significant psychological level. So what does that mean for silver? If you take a gold to silver ratio of 15, which is historically quite important, you divide 10,000 by 15 and you get $666. That's a minimum target for silver. If the ratio compresses to 10, which is entirely possible given the supply-demand dynamics, you're looking at $1,000 for silver. And those could only be initial levels. Remember, we're reaching the end of a paper money era and moving into a real money and real asset period. That means people will want to hold physical products, physical gold, physical silver, physical assets in general, while paper assets decline dramatically. Let me explain something through a thought experiment. Imagine a stadium that you fill with water. Start with 1 drop, double it every minute, 2 drops, 4 drops, 8 drops, and so on. How long does it take to fill the entire stadium? Actually, only 50 minutes. But here's the fascinating part. After 45 minutes, the stadium is only 7% full. In the final 5 minutes, it goes from 7% to 100% full. That's exponential growth. This is exactly how I see the markets in gold and silver moving and how I see the fall of fiat currencies happening. We're going to see exponential moves. In the metals, these will clearly be on the upside. Gold and silver will move at a speed that most people can't even imagine. People who trade technically using stochastics, RSI, momentum indicators, or whatever conventional tools, those tools are going to fail in this environment. Why? Because this is a physical market now, where demand massively outpaces supply. Traditional technical analysis tools aren't designed for this type of fundamental supply shock. Will we see corrections along the way? Of course. It's not going to be a straight line up, but I don't expect corrections like we saw in 1980 or even in 2011. I think corrections will come. We're not quite ready for a major correction yet. There will be smaller pullbacks, but not a major one. A larger correction might come later, maybe in 6 months or so. This is crucial. So smash that like button right now. Comment below with your strategy for the months ahead and subscribe, because understanding the timing and magnitude of this move could be the difference between preserving wealth and watching it evaporate in the coming crisis. So now is the time to consider exposure to silver and gold. A reasonable allocation ratio between silver and gold would be about 70% gold, which is the king of metals and less volatile, and up to 30% in silver, or maybe slightly more of your total metals allocation. You're going to witness the move of a lifetime. But here's something critical to understand. You're not acquiring silver or gold for speculative purposes or to make money. You're acquiring it to protect wealth against the total destruction of wealth that we're going to see in the next few years. That's a destruction of paper wealth that is now at levels unprecedented in history because money printing has been unprecedented and lending has been unprecedented. Countries will face insolvency. Banks will fail in America, in Europe, whether it's due to the property market, commercial real estate markets, or people unable to pay their loans. Doesn't matter. Many banks will go under. Governments and central banks are going to print unlimited amounts of money, and therefore the value of your dollar, euro, or pound is going to collapse. That collapse will be reflected in much higher gold prices. It's not too late yet because we're going to see major moves ahead. Consider physical gold, consider physical silver, and store it safely outside the banking system. For those with larger amounts, storage options exist in secure vaults in jurisdictions like Switzerland or Singapore, places with strong property rights and stability. Think about your family. Think about preserving generational wealth rather than watching it destroyed in paper money, which is what will happen if wealth stays in fiat currencies. Stock markets could decline by at least 90% against gold and silver, probably more, maybe 95%, maybe even more than that. Therefore, don't stay concentrated in conventional paper markets. Consider real assets and hold them outside the banking system in safe jurisdictions. Remember, there will likely be capital controls around the world. You want to stay outside those capital controls by having assets stored in countries that aren't affected by such restrictions. The move we're witnessing in silver right now isn't just another rally, it's a fundamental shift from paper promises to physical reality. The paper markets that have suppressed silver for decades are losing their grip. The physical market is taking over, and when supply can't meet demand, prices have only one direction to go. We're seeing it in real time. Silver over $100 in Asia, while still trading below that in the West. That gap will close, and it will close violently to the upside. The deficits aren't going away. The demand from industrial applications isn't slowing down. The investment demand is accelerating. And the paper market structure that kept a lid on prices for so long is cracking. Every sell-off gets bought immediately. Every dip is met with physical buying. This is how bull markets in physical commodities behave when the fundamental supply-demand picture is this skewed. So as we watch silver approach and eventually blast through $100, understand that this is just the beginning, the exponential phase, that final 5 minutes where the stadium goes from 7% full to completely full. That's what's coming. And when it happens, it will happen faster than anyone expects. The people positioned in physical metal outside the banking system will preserve wealth. Those who wait, who think they can time it perfectly, who stay in paper assets, they'll watch their purchasing power evaporate. The choice is clear. The data is clear. The trend is clear. Silver is not at a top. It's just getting started. Thanks for watching. Stay safe out there, and I'll see you in the next one.